Welcome to our CFP exam prep discussion on non-qualified retirement plans. Today, we're diving deep into a critical area that often appears on the exam. Let's focus on understanding these plans that give employers flexibility in offering benefits to key employees. Non-qualified plans fundamentally differ from qualified plans as they don't have to follow ERISA requirements. They allow companies to discriminate in favor of highly compensated employees and executives. The most common types you'll encounter on the exam are supplemental executive retirement plans, also known as SERPs, and deferred compensation plans. Let's break down the main concept. Non-qualified plans operate under what's called the economic benefit doctrine. This means the benefits are taxable when they're either actually or constructively received by the employee. The employer gets the tax deduction only when the employee recognizes the income. This timing element is crucial for the exam. A key point that students often miss is the unfunded promise concept. Unlike qualified plans, these benefits represent an unfunded and unsecured promise to pay future benefits. The assets remain part of the employer's general assets and are subject to creditors' claims. Many test questions revolve around this vulnerability. Here's a practical example. Imagine a company sets up a SERP for its CEO promising $100,000 annually in retirement. The company must keep these promised benefits on their balance sheet, but they can't set them aside in a protected trust like with qualified plans. If the company faces bankruptcy, the executive becomes just another unsecured creditor. Common exam mistakes occur when students confuse the tax treatment of non-qualified plans with qualified plans. Remember this: with non-qualified plans, there's no immediate tax benefit to the employee, and the employer's deduction is deferred until the employee recognizes the income. The exam often includes questions trying to trick you on this timing aspect. Another frequent testing area involves rabbi trusts. While these trusts provide some security against change in corporate control, they don't protect against the company's creditors. The exam frequently tests whether students understand this limitation. The golden rule for mastering non-qualified plans is understanding their flexibility comes with trade-offs. They offer design freedom and no contribution limits, but they lack the tax advantages and security of qualified plans. This risk-benefit relationship is a favorite exam topic. When studying this material, focus on these key points. First, understand why companies use these plans, typically to provide additional benefits to key employees above qualified plan limits. Second, know the tax implications for both employer and employee. Third, grasp the concept of constructive receipt and how it affects taxation. Remember this real-world application. Non-qualified plans often serve as golden handcuffs, incentivizing key employees to stay with the company long-term. The exam might present scenarios where you need to evaluate whether a non-qualified plan achieves this objective effectively. A critical examination tip is to always consider the security of benefits. When a question mentions creditor protection or bankruptcy scenarios, remember that non-qualified plan participants are essentially unsecured creditors. This principle frequently appears in case study questions where you need to evaluate retirement planning strategies for executives. The key to success on non-qualified plan questions is understanding their fundamental nature as unfunded promises and their role in executive compensation strategies. Keep these concepts clear, and you'll be well prepared for this portion of the exam.